What if I told you the next financial apocalypse won't start in Wall Street, but quietly, in Europe? They say financial crises always begin in America, where the stock markets dictate the world's fate. But here's the shocking truth. The next collapse will erupt not in New York, but across the Atlantic, in Europe, quietly, almost invisibly. And by the time the world realizes, it could be too late. America still has the dollar, the global reserve currency, and a Federal Reserve that can print unlimited money. Europe doesn't. Europe's banks are fragile, governments are drowning in debt, and pension systems are leaking billions every year. The storm is coming, and no one is prepared. Look at Italy, one of Europe's most vulnerable economies. Public debt exceeds 150% of GDP, and the government borrows constantly just to pay interest on existing debt. Italy's banks hold massive amounts of sovereign bonds from weaker EU nations, meaning a default in one country could trigger panic across the continent. Add an aging population and an unsustainable pension system, and you have a perfect recipe for disaster. Millions of retirees depend on promises that the government cannot fulfill, and the younger generation is already overburdened with taxes. The next crisis will start here, because Europe cannot hide its weaknesses any longer. France is another ticking time bomb. For decades, it has promised generous pensions without securing funding for future retirees. When the government recently attempted pension reforms, protests erupted nationwide, showing how politically dangerous it is to face the financial reality. Meanwhile, France's debt keeps growing, banks are leveraged to the hilt, and social unrest adds pressure to an already fragile system. One economic shock, like a sudden drop in government bonds or a banking panic, could send France into a financial spiral that quickly spreads to its neighbors. Germany, often seen as Europe's anchor, is not immune. Its banks are heavily exposed to debt in Italy, Spain, and Greece. Any disruption in these economies threatens German financial institutions. A domino effect is inevitable. A crisis in one weak link, and the Eurozone could face an unprecedented chain reaction. Investors underestimate this risk because Europe appears stable on the surface. But beneath, debt, loans, and political tensions are converging toward a catastrophic tipping point. The pension systems across Europe are particularly dangerous. Countries like Italy, France, and Spain have promised retirement benefits assuming perpetual economic growth and an increasing workforce. Reality tells a different story. Populations are aging rapidly, birth rates are declining, and fewer workers are supporting more retirees. Governments borrow money today to pay pensions while assuming future generations will cover the gaps. It's a house of cards. When it collapses, the shock will reverberate through banks, markets, and global investments. Unlike America, which can extend debt in dollars, Europe's euro cannot absorb unlimited borrowing without consequences. But it's not just pensions or public debt. European banks are carrying hidden risks, non-performing loans, risky derivatives, and exposure to unstable real estate markets. Spain, for example, still carries the legacy of its 2008 property bubble. Italy's banking sector has billions in bad loans waiting to be written off. Germany's banks, intertwined with these weaker economies, are vulnerable to a domino collapse. When defaults rise, banks may fail, triggering a chain reaction across Europe, and eventually, the world. Energy dependence adds another layer of risk. Europe imports significant amounts of natural gas, oil, and other resources. Any disruption, like political tension with Russia, Middle East instability, or sudden price spikes, could strain government budgets further, making debt repayments and pension obligations harder to meet. Unlike the U.S., which can hedge risks with currency control and strategic reserves, Europe faces a complex web of economic and geopolitical vulnerabilities. Here's the shocking twist most analysts miss. Markets are underestimating Europe's fragility. Investors focus on America because it is transparent, powerful, and globalized. Europe's weaknesses are hidden in layers of government debt, interlinked banks, and opaque derivatives. When panic hits, it will appear sudden, even though the crisis has been building for decades. Bonds will fail, banks will collapse, and the euro could face historic devaluation. Confidence is everything in finance, and Europe's system is running on borrowed trust. Let's look at Spain. After the 2008 financial crisis, Spain never fully recovered. Unemployment remains high, household debt is rising, and banks are still exposed to bad mortgages. Meanwhile, the government continues promising pensions and social benefits it cannot fully fund. Any market shock, like a sudden bond sell-off or banking panic, could trigger massive defaults. These defaults won't stay contained. Through EU interbank exposure and derivative contracts, the crisis will leap across borders, reaching Germany, France, and beyond. Meanwhile, Eastern Europe adds hidden pressure. Countries like Hungary, Poland, and Romania have rising debt, dependent on EU support and loans. Political instability, energy dependency, and weak banking systems create a perfect storm. A crisis in Western Europe would immediately strain these nations, further spreading the economic contagion. Unlike America, which can absorb shocks internally, Europe is structurally vulnerable to cross-border financial collapse. The real danger lies in Europe's hidden leverage. Banks are connected through off-balance sheet derivatives, cross-country loans, and complex financial instruments. A small default in one country could trigger a massive chain reaction. In America, bailouts and a strong central bank can contain these risks. Europe's European Central Bank, constrained by law and political consensus, cannot act fast enough. When the crisis hits, panic could spiral uncontrollably, affecting global markets and triggering a worldwide recession. Demographics make the problem worse. Europe's population is aging faster than anywhere else. Pension promises are exploding while the workforce shrinks. Countries like Italy and Germany face declining birth rates, meaning fewer taxpayers to support more retirees. Healthcare costs are rising, social spending is ballooning, and debt is increasing. The system cannot sustain itself without drastic reforms, yet reforms are politically impossible. The next financial crisis will ignite from this exact demographic and fiscal mismatch. And here's something almost nobody talks about: Europe's political instability. Italy has had over 60 governments since World War II. France faces recurring protests. Eastern European countries are experiencing nationalist movements. Political fragility makes crisis management harder. A financial shock will meet not only economic but political resistance, making stabilization efforts slow and inefficient. By the time coordinated action occurs, the damage may already be irreversible.